Velkommen til Rig på Viden, en podcast om forskning i finans, investering og økonomi. Mit navn, det er Henrik Rasmussen. Før vi går i gang, så skal det lige nævnes, at episoden her den er lavet i samarbejde med Enterprise Foundations, som forsker i europæiske fondsejede virksomheder. Du skal tage og gå ind på deres hjemmeside enterprisefoundations.dk, og så kan du læse om den forskning, de laver, og du kan tilmelde dig deres events. God fornøjelse. If you're a shareholder in a company, then you might have very different interests in how the company is being run compared to the creditors who have lent money to the company. Shareholders might prefer the company to undertake risky projects with a potentially high payoff that they can reap the benefits from. But lenders, on the other hand, will not really benefit from the profits of any such risks, as they have already been promised an interest rate on the loan that they have given the company. But any excessive risk-taking might even threaten the company's ability to pay back their debt if they should go bankrupt. If you've been studying corporate governance, then this is definitely a concept you've heard about before. It's called agency conflicts, and this is what we're looking to expand our knowledge on today, and in particular how this agency conflict is affected if the shareholders of a company are foundations. In this episode, I have Caglar with me from Copenhagen Business School's Center for Corporate Governance. To start off, what do you spend your time on at the Copenhagen Business School?
First of all, thank you very much for this opportunity, Henrik, because you let me introduce myself and my research to a greater audience. I am a postdoctoral researcher at the Department of Accounting in Copenhagen Business School. And as you mentioned, I am working at the Center of Corporate Governance in our department. I am currently conduct research on corporate finance and corporate governance. Just like to give information about my background, I have a PhD in financial economics from Lund University in Sweden. My research areas are corporate finance, financial economics, and industrial organization.
So, Caglar, how did you develop an interest in researching credit risk? Because that's what we're going to talk about today as well.
Mm-hmm. I started to work in finance sector after my bachelor degree. I worked for 5 years in audit and banking. I was first auditor, then credit risk analyst, and then finally I was like corporate banking manager in Istanbul. I work in HSBC, Turkey, in the headquarter office. Since the graduation from my bachelor degree, I have been dealing with credit risk or assessing the firms. So therefore, I was working in the department which was granting a loan to the large corporations. So we were granting loans. We were assessing the credit risk of the firms. Of course, we were doing some internal rating for these firms. And I was working in a country which is like kind of financial sector is not very stable, so I have a great experience also in credit risk. Then later on, I quit my industry career and I started to do my PhD in Sweden in Lund University. So, and when I was choosing my dissertation topics, I chose corporate growth and corporate credit risk.
And back then in HSBC, did you ever rate a foundationally owned company or a controlled company?
Yes. For example, I was the responsible analyst from the automobile supplier industry. Yeah. And we have a company in Turkey called MacLeod Turkey, which is the wholly owned subsidiary of the MacLeod GmbH, the German company. And this automobile supplier is a multinational company, German company, and they are wholly owned by the foundation. Mm. So this was even my first exposure to foundation, because, when you are granting credit limits to the companies, you are asking, if they are like a subsidiary of a company, you are asking the co-signer agreement from the parent company. And then also you are evaluating the financial statements of the parent company. So you are paying attention to ownership, in fact. So, of course, when there is a foundation, as a credit or risk analyst, we were attributing less risk to the firm, because we know that foundation will be always there.
Okay. You actually did that back then. You were aware that there should probably be some kind of extra security, perhaps, in a foundational.
Of course, and then especially for this specific firm, I don't know what extent we should be talking about a specific example. But for example, this firm, for the German firm MacLeod, the financial statements of the parent company in Germany was very good, as well as the financial statements of the company in Turkey too. But also the thing is that that when the ownership structure is a little bit not complicated and there's one controlling body, then as a banker, you are on the safe road. Therefore, of course, there are many factors influencing the credit risk, but the factors coming from the ownership the risk is minimal there, because in the next meeting next year when you meet the company representative, that still the owner is the same entity.
Yeah, you need to know who you get into bed with when you.
Of course, as a banker, of course. I mean, you put so many covenants, you put security things, but also the personal relationship the relationship between between the bank and obligor firm is very important. So the management of the obligor firms shouldn't change a lot from the banker perspective.
Okay. In our previous podcast, we've had a few with Sten Thompson and also Jonas Schröder, a few of your colleagues. We've actually already discussed foundation-controlled companies and how they typically live longer, they operate for the longer term, they have a business with a good purpose in society, and they are more profitable sometimes compared to other businesses. In theory, would these be factors that can help lighten this agency conflict I introduced earlier between shareholders and creditors?
Mm-hmm. Yes, in the academic literature, we have 3 types of agency problem, and now we are here talking about the agency problem type 3, which is the problem between shareholders and the creditors. The thing is that both creditors and the shareholders, they provide finance funds to the companies, but however their interests are not exactly the same, because from the point of view of shareholders, they want the firm to be more profitable. So the more profitable, of course, they will get more dividends from the firm. But on the other hand, creditors, their interest is just that they want to get back their loan and also the interest rate. So it doesn't matter for of course, they want the firm profitable too, but the firm should be profitable as much as to pay back the debt and the interest rate. So then there should be some conflict between these two parties, because shareholders want the firm to invest risky projects to get a higher capital gain, to get higher dividends, of course. But at the same time, creditors prefer more stability. They want the firm to stay longer. But for example, some shareholders might be short-sighted, and they want, for example, private equity firms. They invest in the firms, their investment horizon is shorter. Therefore, but when we come to the foundation-controlled companies, foundations, they cannot change the ownership of the firm that they invest. I mean, they cannot sell the firms based on their charts most of the time. So if there is a foundation owner in the firm, then they are also, as you say, they emphasize longer term growth, they emphasize sustainability, and we can characterize these foundation control firms with management continuity, for example, long-term governance, long-run investment, and higher survival rates. And all these things, all these characteristics are the factors that are also factors which mitigates the credit risk from the creditors, debt holders' perspective. So in terms of agency problem type 3, we can see that foundations ownership, or controlling ownership, I should say, is a factor that might mitigate the credit risk of these firms from the debt holders' perspective.
Yeah, and I think you just mentioned this survival rate, so the rate of the companies that survive and don't go bankrupt, and that's pretty important when you are a lender, right? Because if the company you lend money to goes bankrupt, that means they cannot pay back their loan. And if you are a shareholder, at least in theory, higher risk is higher returns, right? We like to say that in finance. And since you're a shareholder, you have a diversified portfolio, 100 different companies, and you just want them to take risk. Because if one of the companies goes bankrupt, doesn't matter. You have 99 others. You are diversified, right?
You touch very important point, because from the individual shareholder perspective or this institutional investor perspective, they have some kind of opportunity of diversification. But from the banker's perspective, diversification is not that possible, because as a bank, you are giving maybe most of the time a huge amount of loan to this firm. So you are more depending on the individual risk from the obligor firm. But as an investor, of course, you can diversify, and you can, for example, if something happens in one of these firms that you invest, or you bought some shares from that firm, but it's not a problem, because based on the diversification principle, you can handle that risk. But from the banker perspective, creditor perspective, I mean, of course, the banks have also portfolio. They are lending to many firms. But from the diversification perspective, bankers are not that lucky. Creditors, I should say.
Yeah, and bankers would prefer that their whole portfolio is just stable and pays back their interest rate.
They want to decrease their non-performing loan ratio, of course.
Yeah, they don't benefit from those high risks with a potential bankruptcy as a consequence. All right. You know what? Actually, I think maybe we should start by defining what is a foundation-owned company. That's like Novo Nordisk, right? And Carlsberg Fonden. They own Carlsberg.
In this research, we are focusing on these public listed companies. But some of these companies are owned by the main shareholder is the foundation. And we call this foundation enterprise foundations, when they have some kind of they own some companies which are doing businesses. And for example, from Denmark, we have the example of the Novo Nordisk, Maersk, and from Germany, for example, MacLeod. And then from Sweden, we have the Wallenberg Group. So there are some examples, but to be honest, most of the examples are coming from the Nordic region. Okay. So when it comes to your question, I mean, of course, this most of the time, this based on their charter, these foundations are not allowed to sell their companies. So they are always there. And in this sample that I am focusing in my research, I mean, the main blockholder, the shareholder, is the foundation. Of course, these are publicly listed firms. I mean, there are other individual investors or other institutional investors who are buying the shares of these companies, but the controlling owner is the foundation.
Yeah, and I think the research we're going to dive into today, it's not just that it's 50% or more that's owned by the foundation. It's also, what is it, like down to 10% ownership?
Yes, exactly, 10%, 20%. But in this sample, most of the time, I should say that the foundation, they mostly own the 40%. And also we shouldn't forget that sometimes they have more controlling rights.
Yeah.
And especially in the publicly listed companies, I mean, they own the 30% or 40%, but then the rest of the shares are dispersed among different investors or individual investors. So in this sample, the companies, we have foundation control companies, and we have also control group, which I will give you a detail later on. I mean, for the foundation control companies, I mean, we should say that they are controlled by the foundations.
And as you said, the foundation is actually set up with the purpose of owning this company. It's not allowed to sell the company. And that also means that the company, Novo Nordisk, for example, is not for sale. It cannot be sold to another large interested shareholder or a capital fund. And why would you care about that as a creditor if you've lent money to the company?
Of course, from the creditor's perspective, you know that the owner will not change, the controlling owner. So creditors are sure that foundation will always be the controlling owner in the obligor firms. Bankers prefer see the stability in the management, in the owner. As I told you, because most of the time, even in the short term, when you are granting short-term loans, you like this, like this is consignor agreement, for example. So from the creditor's perspective, the stability in the management, and I should say stability in the ownership, because there is no risk that the firm should be bought by another party. For example, In a normal firm, I should say, in a firm with a conventional ownership structure, when the owner sells the firm to another firm, for example, private equity firms, for example, they are very short-sighted. They want to increase the profitability of the firm as soon as possible, and then they want to resell it. For example, from the creditor's perspective, this is not that good. So I should say that foundation control companies, I mean, it can be publicly listed companies like in our sample here, or it can be privately owned foundation firms. Foundation control firms are the safe harbor for the creditors, in my opinion.
Yeah, and one thing you could be afraid of if a company is bought by a capital fund could be that they leverage the company a lot, right? They change the operations,
exactly.
of course, but they maybe leverage, take a lot of other loans.
Yes,
and that will make the
cost of debt. The cost of debt from the one bank perspective. If I am already the lender in that firm, and if the new owner, let's say private equity firm, if they borrow from other banks, then the cost of debt is increasing. So my debt is not as valuable as before. So therefore, but in the case of the foundation control firms, I know that I know the counterparty will not change. So next year, when I renew the credit limits, when I discuss the conditions again with the obligor firm, I know the management and the board of directors are controlled by the same entity, which is foundation. So from the credit risk perspective, this is something good. This mitigates the credit risk, I should say, like that.
Okay. How about if we take a look around in the scientific literature, what does that tell us about how corporate governance affects credit risk and credit conditions?
First of all, I should mention a point. There are some studies and academic articles that are focusing the effect of the corporate governance and credit risk. And when we're talking about the effect of corporate governance on credit risk, of course, we are mentioning this agency problem type 3, the conflict between shareholders and creditors, or the conflict between creditors and the company management. Okay. But I should be honest that both in corporate finance literature and corporate governance literature, most of the time they are focusing on the agency type problem 1, which is the problem between the managers and the owners, or they are also focusing more on the agency problem type 2, which is the conflict between the majority shareholders and minority shareholders. Okay. Because all these academic research are based on the United States data. So in United States, shareholders' right is the most important thing. Yeah. Profit maximization is the most important thing. So I should say that academic research is more focusing on these agency problems. But there are some studies focusing on the third problem too. And when we look at the literature, for example, we can see some articles giving us some findings. For example, lenders assess and price a company's corporate governance bodies, for example, board of directors. So, for example, if there is less effective board monitoring in a firm, then they are attributing more credit risk to these firms. This is one of the findings. And another finding, for example, creditors facing the company's management opportunistic behavior, then they are also asking higher yields from these companies. Opportunistic
behavior
of the management, because as you know, especially in these public listed firms where even there is already a tension between the shareholders and the management, the managers they can do something like empire building. They can, instead of considering the interests of the shareholders or the creditors, they might focus on their own interests, and they want to invest in risk project to get higher bonuses in the short run, etc. So therefore, these are all the credit risky things from the creditor's perspective. So if the creditors see that there is opportunistic behavior from the management, then this is not good for because based on the theory, the creditor is only interested to get their money back and also the interest rate. I mean, it doesn't matter the firm really, really very profitable, just enough profitable to pay back their debt and the interest rate.
Yeah.
And another, for example, important finding from the literature is that really creditors are paying attention not only the market position or financial performance of the companies, but they are really paying attention to corporate governance. Who are the owners? and who are sitting in the board. And there are some studies, for example, even looking the what is the effect of board diversity on the bank loan conditions. So there are some research, but I should say that the research is not as deep as in the research addressing the agency problem type 1 and type 2.
Yeah. Then I think we could dive into your article, because you're actually working on something right now called Ownership and Creditor Governance, Foundation Controlling Ownership in Publicly Listed Corporations. That's at least the title right now, because it's not public yet. What motivated you to write this article about credit risk and foundation-controlled companies?
Yes, when I started working on the Enterprise Foundation project, first of all, thank you very much to all these foundations who are like sponsoring, funding our research project led by Stern Thompson. And my background is corporate finance, so I would like to bring my knowledge of corporate finance and specifically credit risk knowledge to this current project. And immediately I remember my experience from my banking sector that I told you in the firm, that when I was working in the bank, there were some firms owned by foundation. I mean, I gave the example of the German firm, but there were also some firms, for example, in Turkey, in the army industry, which were owned by foundation. So that's why I immediately, based on my industry experience, I thought about these research projects, and then I would like to focus on the credit risk of these firms, foundation control firms, and then, for example, in the first project, this is my second sub-project in this project, but also I work on the board governance of these firms in another research paper. So, I mean, what motivates me, like my industry experience and, of course, my credit risk knowledge from my academic knowledge from my PhD. So I would like to really conduct a research about credit risk of these firms, because this is not a conventional ownership type. This is this is not, for example, almost doesn't exist in the United States or Anglo-Saxon system, but this is a very, very niche ownership type, but it might be a solution maybe to some issues that we have seen in capital system. I believe that's why I would like to focus on these firms, honestly.
Yeah. It also sounds like if you already back in your days in HSBC were aware that you should probably credit some points to foundation control companies, it's a good chance for you in this research to kind of confirm if that's actually something you should do, or if it's something that the sector is wrongfully doing.
Exactly. Also, you can see some findings about the financial performance of this firm, both in this research article, also in my previous article. We can see that most of the time, on average, these firms are less leveraged than the other firms. I mean, what I mean by other firms, the firms owned by the conventional owners. Okay. So, and also when we look at the profitability ratios, these firms most of the time at least as profitable as the other firms. So they are not performing worse than the industry average. So these things, yes, academically, they are confirming my expectation or my industry experience from the past.
Yeah, and that was actually what I was gonna ask a little bit about, because in the article you're looking into the credit worthiness of foundation control companies, and I was wondering, how do you go about this? Do you look at the public credit ratings or debt to equity ratios or profit margins, as you mentioned? Mm-hmm. What are you looking at to evaluate the credit risk of these companies?
Okay, first of all, of course, if you approach from the academic perspective, it is not very easy to measure credit risk, but we have some measures or indicators. Specifically in this research paper, I use 4 types of measures. I mean, I have 4 measures to measure credit risk. These are the Standard & Poor's long-term credit ratings, which is, and then the second one is the credit model score, again provided by the S&P, but based on a different algorithm. Okay. And the third proxy for the credit risk is probability of default. We are calculating the probabilities of default for the firms in the sample. And the fourth one is the Altman Z-score, which is a more accounting-based score showing how much the firm is away from the default point. So it's also a measure of credit risk based on more on the financial statement variables. When it comes to the equity ratio, debt equity ratio or profit margin, I mean, these are if you look at the academic literature in the corporate finance, these are the common risk determinants. So these are the factors creating or influencing credit risk. So not a measure of the credit risk, but factors influencing the credit risk. So, and in this research, we control for the debt equity ratio, which is the leverage ratio. It shows how much the firm is indebted. And then the second also profitability ratio, we use, for example, different measure, but one of the measures is, for example, EBITDA over sales, which shows the profitability. Of course, the higher the leverage, the higher credit risk, the lower the profitability, higher credit risk. So we control for these factors when we are looking at the effect of the ownership on the credit risk. And here, what I mean by ownership, of course, we are looking the effect of whether the foundation control influencing credit risk positively or negatively.
Yeah. So in the article, your findings indicate that companies with foundations as large shareholders, they have a higher creditworthiness than other companies. How did you see that in your data? What kind of indications pointed towards that conclusion?
Yes. First of all, in this paper, in the sample, as I mentioned before, all the firms are publicly listed, and we group the firms into two general groups. Like the treated firms here, what I mean treated is the firms that we are focusing, foundation control publicly listed firms. Yeah. And then the control groups are again publicly listed firms, but where the main shareholder is either a family or institutional investors like asset management companies or private equities. Okay. So, and we compare these two groups. Why we are comparing this group? Because family and retail investors are the established, like conventional owners, but foundations are not new style, I should say, niche owners. And when we compare these firms, we run, of course, some descriptive and regression analysis. And on all four measures, I should say that, for example, foundation control firms have a higher credit ratings. They have a higher credit score, which means they have a lower credit risk. And also they have a lower probability of default, which means lower credit risk. And when it comes to the Altman Z-score, when the firm has a higher score, it also means that the firm has a lower credit risk. And the foundation firms, on average, I should say shortly foundation firms, they are less risky than other control groups. And this is the first in the descriptive studies, so we ran some t-tests. They were all significant. But then also in the regression analysis, we control for other factors influencing credit risk of the firm based on the literature, like as we mentioned, leverage ratio, profitability, and, for example, stock performance of these firms, stock return, for example. We control for all the main credit determinants, but still we can see the effect of foundation control on the credit risk, and this effect is negative. So which means that the control of foundation decreases the credit risk of the firms.
Yeah. Okay. Yeah, sounds like very solid results. Is that also when you control for sector and size, like for example, only compare companies within sectors and within size buckets?
Exactly. If you go more detailed to empirical details, we control for the firm heterogeneity factors, and we control for the industry. So this, and in the regression, still our results are robust when we control for the industry factors and the firm specific factors. So on average, both in the descriptive analysis and regression analysis, on average, we can see that foundation control companies have lower credit risk, and these are confirmed by all these credit risk measures. So it is good to use more than one credit measures, because some of them, for example, some of the firms, they don't have credit ratings from the Standard and Poor's. So then we rely more on the default probabilities. And especially we can calculate the probability of default for all the firms in the sample, because this is something that we are calculating as a researcher. So all these firms, the foundation control firms, on average, they have a lower probability of default than the control group firms. And again, I want to mention the control firms are again publicly listed firms, but where the main shareholder, block holder, is either a family or retail investors.
Yeah. Just to perspectivate a bit to your colleagues' research, so your results within the credit risk of foundation control companies, are they in some way more robust than your colleagues? Like, is it more significant, or?
I should say that we run both descriptive analysis and the regression analysis, and on all these credit risk measures, yes, we have statistically significant results. I don't want to go more detail because these are really like more academic details. So, I mean, at some point, for example, what is the most important thing in terms of credit risk? For example, the survival, am I right? And even when you look at the age of these firms, I mean, foundation control firms, on average, they are older than other publicly listed firms. Of course, there are other conditions. You shouldn't look only one factor, but I should say that there are so many findings showing that foundation control firm, on average, of course, there might be some exceptions, but on average, foundation control firms are less risky than other type of firms when we are controlling for the common risk factors like leverage, like profitability, like stock return. And we decide control variables based on the Merton model, which is the most established model in credit risk field in finance. So, for example, the higher the stock return, because stock prices are the expectation of the investors about the firm's future. So the higher the stock prices, higher the stock return, of course, the firm is away from the default bankruptcy. So this is, for example, a common credit risk determinant. But we control for this. After even controlling for all these factors, there is a statistically significant effect of foundation control on the credit risk. And this effect is negative, which means that if there is a foundation in the ownership structure controlling other credit factors, we can see that there is a less credit risk in the firm. And we show it as a higher credit ratings if the firm is rated by the Standard & Poor's, or higher credit scores, again from the Standard & Poor's. And maybe you might ask that what is the difference between the credit ratings and credit score? Because Standard & Poor's don't rate all the firms in the world. But when it comes to the score, they are providing scores for everyone in the world. Even the firms, they don't ask score from them. So even in both measures, we can see the foundation control firms, they have a better score, better rating, and which means lower credit risk.
Yeah. And is there some intuition behind these results that we haven't already talked about? Did you find or think about anything else during the project? Okay.
I mean, one can approach the topic from this perspective. There is a literature there's a literature about like majority owners. If there is a block holder in the company's ownership, this might create some risk for the creditors or for the minority owners, because the main shareholder may expropriate wealth from the minority shareholders or from the creditors, which means more frankly, so the main shareholders might force the management of the company to invest risk project. But in our case, for the foundation control firm, this is not an issue because foundations are always in the company. Okay, and also since they are long-term owners, they also control management more efficiently. And controlling management more effectively is also good for the creditors, because as I said, there is also agency problem between managers of the firm and the creditors too, because if the managers are self-oriented, then this is also bad for the creditor. So even from this perspective, foundation control firms foundation control is a mitigating factor for the creditors. even though we know in the literature that sometimes controlling ownership might be risky for the creditors or for the minority shareholders. So at that point, maybe it looks like there might be our results of the results from this paper might look at like an anomaly from that perspective, but there is no anomaly here.
Yeah. So to conclude on this, what do you think that the benefits are for the foundation-controlled companies by having this higher credit worthiness?
Okay, as I've told you, this ownership is not common all over the world. But we have some problems from the Anglo-Saxon ownership structures. I think foundation control firms or foundation-owned firms. I mean, you can talk also in general. Might be a good ownership structure because, first of all, for example, in these publicly listed firms, as I said, they are like focusing more on sustainability. They are focusing on more growth. They are focusing on more employment, these companies. So, but for example, for this publicly listed firm, they are also attracting capital from the individual investors. So, okay, these companies that I told you, 40 or 30% owned by the foundation, but the rest is owned by the public, by the stock market. So they are also governing, or managing, whatever you say, the funds of the other people in the direction of sustainability or employment. So these are important because, for example, as an individual investor, I bought the stock of Novo Nordisk, but I know that this firm is, compared to other conventional firms, the ultimate goal is not only profit maximization. I mean, at the end, the foundation, they don't have a profit maximization goal. So they rule also the funds of the other people in a direction other than profit maximization, I should say that. Of course, they are paying dividends. They are paying, I mean, you can also sell the shares when you buy the Nordics, you can sell your shares too. But at some point, they are collecting capital from the market and they rule this capital for some kind of projects other than like for a philanthropic perspective, I should say. So this is, I think, might be is a good example for ownership, in my opinion, if you approach the topic from the philosophical perspective.
Yeah. How about that? So I would say if foundation-owned controlled companies have a better credit rating and lower credit risk, they should also have access to more capital, more loans, right? And they should also be able to receive loans at a lower interest rate just because of their ownership structure, which is the case, right? They get lower interests, and that must be a good thing, right, for these companies.
Your question is very very meaningful at this point, because in the second part of the paper, in the first part we find the result that these firms are less credit risky. Am I right? They are more credible firms. But what are the implications? And then, or what is at some point we should prove that from the real life experience. Again, based on my banking experience, I said, let's look at the bank loan data. Unfortunately, we don't have, when it comes to the bank data, it is very confidential and it's not very easy to access bank loan data all over the world, not only in Denmark, all over the world. But there is one big bank loan data source from the United States, which is DealScan. So, and in our sample, almost like half of the sample firms, they have some data from that database. So we look at the syndicated bank loan database, not the short term, but this syndicated bank, and most of them are long-term loans, but which is more important because long-term loans give you more information about the credit risk of the firms, because in the short-term loans you are given just 1 year, and there are other factors that the banks are considering when they are lending in the short term. But in the long term, banks are focusing more on the credit risk of the firms, in more detail, since the amount is bigger and the maturity is longer. So in the second part of the paper, based on the syndicated bank loans data, we can see that first of all, there were many loan characteristics like covenants, whether the loans are secure, and maturity of the loans, how many lenders, we can see all these kind of details. So, for example, we can see that foundation control publicly listed firms, on average, they are providing less security covenant for their loans.
Huh?
Which means if you are more credible, of course, the banks will ask less covenants, less conditions from you. So we clearly see this in the data. And when it comes to the pricing, of course, what is the general intuition here, that if you are less credit risky, of course, the bank will put less margin over the LIBOR rate. Am I right? Yeah. So based on the data, but unfortunately, always the interest rate data is very limited. But based on the limited data, we can also see that on average, foundation control firms, they pay less interest rate.
Okay.
Yes, and also one of the bank loan characteristics is maturity. For example, of course, the lower credit risk, the higher chance as an obligor firm you can borrow from the bank. Am I right? Because the longer the maturity, of course, the banks will have a tendency to give to these loans to the companies which are less risky. Yeah. So in this sample, on average, again, the foundation control firms, their syndicated loans are longer than the syndicated loans of the firms in the control group. So these are important. But for example, we also look the number of the syndication loans per year and the amount. We didn't see any statistically significant difference. But we can say that in terms of maturity, in terms of security conditions, and in terms of the price, like the interest rate, foundation control firms are benefiting from their name in their banking relationship. I mean, they provide less covenants, less security when they are having syndicated loan relationship with the banks. So this which means that this comes to the final point that these companies have a higher assets or cheaper assets or assets with less conditions to the bank financing. And as you know, bank financing is important even for the publicly listed firms.
Yeah, so you look at the actual loans of these foundation control companies, and what you see is that compared to other companies, they pay lower interests, they have longer loans, they have loans with easier conditions, these covenants, as you mentioned.
Yes.
So that all sounds pretty favorable. Would an advice be in general to foundation control companies, for example, be that if they are not looking at borrowing money, if they are not really using that opportunity, they should maybe actually think about it because their conditions are maybe going to be quite favorable.
Exactly. And then, of course, as I mentioned, these are the publicly listed firms. But this result might be more influential, meaning for the firms, for the private firms. Okay. So foundation ownership might be a good alternative for the startups or for the small firms, because also bank financing is more important for these firms. Yeah. So they should know that as long as the creditors know that the foundation is there, the owners will not change, and there is an owner there which emphasizing long-term growth or sustainability, then you will have a higher access to bank financing. People know. I mean, of course, bankers evaluate your financial performance, bankers evaluate your business relation, your market position, but bankers are also evaluating corporate governance of the firm, which is, of course, very linked to the ownership structure. So at that point, foundation ownership might be a solution for the private firms or for the startups for attracting more capital. Of course, for these firms in this sample, these are publicly listed giant firms. They don't have that much problem in accessing the capital. But still, you never know. I mean, every firm has a growth and then going down cycle. Am I right? But clearly, we can see that even in the publicly listed firm sample, foundation control firms have an advantage in accessing the capital compared to the public listed firms, where we see other block holders like families or institutional investors.
Yeah. All right. Extremely interesting article. Really, really cool results. I got to commend you on that. Good work.
Thank you very much for your appreciation.
You're welcome. I think that's it for today. It was a pleasure talking with you, Caglar. Thank you for being with us.
I thank you for this opportunity, as I said at the beginning, because you gave me a chance to reach many people through this podcast, and maybe hope to see you in other articles, in other research projects. Thank you very much. Have a nice day.
Thank you. Tak for, at du lyttede med til Rig på Viden. Jeg håber, at du lærte noget, og hvis du nu synes godt af vores podcast, så kan du støtte os ved at følge den på Spotify eller skrive en anbefaling på iTunes. Inde på LinkedIn, der kan du følge André Thormand, Benjamin Somofen eller Henrik Foged Rasmussen. På genhør.